All right, what's going on, y'all? Welcome back to Average Money Works. Thank you for tuning in. Hope you guys are having a happy holiday weekend, spending time with your family, all that good stuff. If you guys are not in the stock market yet, why are you not in the stock market yet? If you got some money over the holidays, this is a perfect time to use that money to get into the stock market. If you have not started yet, there's a link down below. Click that link and you guys can create an account and get a free stock. So free money right off the bat on top of any money that you put in. If you guys have not started and you don't really know much about the stock market, go ahead to my YouTube homepage, go to playlists right here, and I have Getting Started in the Stock Market playlist. These are all my videos that I have. Everything you need to know about getting into the stock market, investing, why I think everyone should invest in the stock market, how is this going to benefit you, how can this help you reach your financial goals, and determining how much you need or how much that you can use to invest in the stock market. So make sure you guys check out those videos. This video right now, today, is going to be about what stocks to buy. So let's go ahead and dive right in. Before we begin, make sure you guys like the video, subscribe to the channel, hit that bell, that way you guys can get updated and notified every time a new video is posted and released. Also check out my financial freedom journey, so how I'm taking 2,100 and using that to pay off debt, reach my financial goals a lot faster. So getting into this, which stocks to invest in and when. So we're looking for long-term investing, so you want to buy stocks to hold for very, very long, years and years and years. And basically, now is the best time. There is no perfect time to get in. Now is the perfect time. So if you're not in the market yet, this is the best time to get in. So Jim Cramer from CNBC, he shares his number one rule for investing. So if I scroll down, basically what he says is you should have about 10 to 15 stocks in your portfolio. And that's a pretty good sized portfolio as long as you're covering 5 different areas in the market. So if I scroll down just a little bit farther down, he explains which 5 areas you should get into. So gold, a dividend paying with a high yield, a growth stock, speculative stock, and stocks with a healthy geography. So if you don't really want to go that far and you just want to basically put money in the stock market and not have to look at it every day, week, month, or anything like that, you just want to put money in and let it sit there, you can invest in the SPY. And the SPY is basically its own stock portfolio. So if you don't want to spend the time looking for companies or owning 10 to 15 stocks, you can put your money into an ETF, which is the SPY. And this basically tracks 500 of the best large cap and mid cap US stocks. So if you don't know what those are, it's companies like Apple, Microsoft, Amazon, Facebook, Google, Tesla, Johnson & Johnson, JP Morgan Chase. So if you already bank with Chase or you buy Johnson & Johnson products, you're on Facebook every day, you own the Apple iPhone and watch and MacBook and all that, these are great companies to invest in because you already know the company, you already invest in the company, and these cover different areas in the market. So like I said, a dividend paying stock, a growth stock, speculative, all that stuff. So if you don't want to go through all of this, you can invest in SPY. If you don't know what companies are out there that you can invest in, you can look inside the SPY like this and see which companies are in there. And if I go back and just look at the SPY on Robinhood really quick, you can see the growth potential with the SPY. So over the past year, the SPY has gone up 14%. So if you invested in the SPY at the beginning of the year, January 1st, right now you'd be up 14% on whatever money you put in there. Versus if you just kept your money in your regular savings account at your local bank, or if you bank with Chase or Wells Fargo or anything like that, you're looking at a 0.05% average annual rate of return on your investment. So you got less than 1% keeping it in a bank, and you got 14% investing in the SPY. So if you don't want to spend all that time looking at stocks, figuring all that stuff out, you can just throw your money in the SPY and call it a day. If you want to be more controlling of what your portfolio and where your money is going, like I said, look into these things, look inside it, or look for companies that you already invest in. And as long as they're trending up, like Apple here, this is why Apple's inside the SPY, because over the last month, it's gone up 13%. Over the last 3 months, it's gone up 21%. Over the last year, 85% up. And over the last 5 years, 392% up. So as long as you're putting money in companies that are moving with the market, you're in good shape. Me personally, I didn't invest in gold, but I invested in Bitcoin. So I have my money in Bitcoin. My high dividend yield, companies that pay their shareholders for investing, it's like AT&T, Triple M, IBM. I'm in AT&T. So what you can do is if you go look at the company, like Apple here, Apple pays a dividend. Where is it? They pay a 0.61% dividend. So you want to look for a high one. So real estate stocks like Realty Income, it's $60 per share and they pay a 4.55% dividend. So that's a high one. If you look at Main Street Capital, another real estate company, they pay a 7.91%. It's cost $31 per share. So if we go to our dividend calculator and just type these in and see how much they pay, we got 31 right here, and this was 7.91. What? Okay, so you'd get $2.41 every year for owning one share. So you put $30, $31.10 into Main Street Capital, and every year you're going to get $2.46. They pay these out quarterly, so you'd have to do this divided by 4, and you're going to get about 61 cents 4 times a year. So if you just add money every paycheck or every month and you buy one share every single time, you're going to be multiplying this by however many shares you own. So there's your high-end dividend stock. Like I said, I'm doing with AT&T. So right now AT&T is trading at $78.75. Their dividend yield is 7.25. So I'm getting about $2.08 per share. I own 7 shares. So if I multiply that by 7, I'm going to get about $15, $14.56 every year for owning these shares. And I'm going to be doing exactly what I was saying, buying shares as my account grows. So if you want to know how much of a stock you should buy, you don't want that stock to be worth more than 10% of your portfolio. So if your portfolio right now is at $2,300 like mine's, then you shouldn't have more than $230 in one stock. So if I do end up having that much, then it's time to move on to another company, reach that, or add. So right now I'm at 5 companies right now, and I'm looking to eventually get to 10 as my account grows. So moving on to the next type of stock, a growth stock, so a company that's growing faster than the market. So you saw the SPY is growing at 15% this year. So any company that's been growing at a higher than 15% rate is a growth stock, especially ones like Roku. Like this year alone, because of the stay-at-home orders and everybody being on lockdown and staying at home, everyone's been buying Rokus and subscribing with Roku. So over the past year, Roku's up 143%. So clearly a growth stock because it's growing very, very high, very, very fast in a short amount of time, up 95% just in the last 3 months. 143% just this year because of the lockdown. So companies that are benefiting from the current, economic conditions. So Roku would be a good one. I'm an Apple. It's not really a growth stock just because it's been around for so long, but it does move a lot higher and faster than the average market. So that's my growth stock. If you go to my growth account journey, you can see how I've been investing in Apple, basically not spending any of my money and just using money that I've made to invest in Apple. So it's basically a free investment for me. Speculative stocks, you got stocks that are a bit higher risk. They are either new, they just got added to the market, or nobody really knows about the company yet and you're expecting the company to grow, like DraftKings. So if I look at DraftKings right now on my account, it's at $52.13. Over the last year, it's up $376. Again, because of the pandemic and the lockdown, people started betting online instead of going to the casinos. So if you just real quick think about what kind of economic condition we're in, you can kind of determine which companies would be speculative. Companies that are cheap. You also have companies like SPCE, Virgin Galactic. So they're trying to make space tourism a thing where you can actually take a tour to space. So this company is right now $25.83. So if you believe that space tourism is going to launch basically in the next couple years or so, this would be a good speculative company to invest in, and just hope that one year or so this thing's going to skyrocket to like $200 a share. So something that's more speculative, and that's why you only want to have 10% of your portfolio in one stock, because if this doesn't go off like you expect it to, your other stocks are going to hold your account and you're not going to blow up and lose all your money. So if I go back to my account really quick, you can see here my AT&T shares, I'm down $11 on it, but my Bitcoin is up $15. So they basically cancel each other out. So if I just put all my money in AT&T because I wanted the dividend, I'd be down a whole lot more. My account would be down a whole lot more than $6. And that's basically why you want to have a diversified portfolio, so you can cover different areas in the market. So when one area skyrockets, like tech areas right now in the pandemic, you can benefit from all of that stuff. And then after the speculative, you want to have a healthy geography, so a healthcare company like J&J, United Health Group, Abivai, Teladoc, those kind of companies. So if you have J&J products at home, you can invest in J&J. The health industry is not going to go anywhere. Obviously, we're always going to need healthcare. So that's another safe investment where you can put your money. And if I just look at UNH, which is what I'm in right now, United Health, over the last year, United Health is up 15%. So about the same as the market. So very safe. It moves with the market. Over the last 5 years, we're up 192%. So another safe company to invest in. It grows year after year, and that means that I'm going to be making money. So as long as I'm adding funds to my account frequently and periodically and on a schedule, basically treat it like a bill, my account's going to continue to grow. And if you follow along with what I'm doing, I'm basically investing money that I'm making and using that money to pay off debt. So make sure you guys check out that portion of my video. And then once you've been buying shares and shares and shares and you own 100 shares of a company, then you can get into selling options. And that's just another way of adding more income to your portfolio and basically your net worth. So that's going to be in the next video. So make sure you guys stay tuned on how you can use options to generate more income. If you guys have any more questions on these topics, leave a comment down below. I'll answer that in the comments or in the next video. Otherwise, happy holidays, happy new year. Take it easy. All right. Peace.